Hey everyone, it's Conrad Bobby here, CEO of Investors Prime Real Estate and best-selling international author of Australian Real Estate Investing Made Simple. Welcome to today's video. You know, there's a funny thing that happens with whether it's cars, property, or watches. It's called good, better, best. And there's a point where that occurs when buying things where when you go to the next stratosphere of pricing, there's no point buying that particular brand or suburb or car. For example, let's say you're looking at entry-level luxury cars and you've got the four major cars. You've got BMW, Audi, Mercedes-Benz. Let's say you just got those four, for example. So you probably could argue, and this is just an opinion, good is Audi, BMW is better, Mercedes is superior. So if you've got, say, $50,000, you buy an Audi. If you've got 80,000, you can do a C-Class Merc, or you can do a good, BMW 5 Series. If you've got 200,000, you buy a Mercedes. Well, if you got 400,000, you don't buy a Mercedes, you buy a Bentley. So what happens is there's no point buying a particular brand at a pricing where you can go to the next level up with brands. And that has to do with reliability, quality of workmanship, resale value. There's a lot of arguments why. And so I've noticed the same thing with suburbs, where there's a price point where there's no point buying in that suburb anymore. You might as well just go to a better suburb. For example, and this is just an opinion, okay? Don't send me emails, okay? Let's say, for example, Bentley, Brighton East, Brighton. Very simple example. Good, better, best. Bentley, to get a nice 5-bedroom house with a pool, you're looking up to $2 million now. The moment you get to 2.5, I would argue you might as well go to Brighton East. There's no point buying Bentley for $2.5 million, unless it's like a super mansion in a really nice street, in a school zone, and it's got everything that you want. But really, 2.5, you can get a really nice 5-bedroom house in Brighton East with a pool. The moment you go up to $4 million, there's no point buying Brighton East. You might as well just go buy Brighton proper, because you're going to get more capital growth. You're going to get there's more prestige, etc., etc., etc. So I've noticed this with cars, with watches, for example. Is the same thing. You have Tudor and Rolex, for example, right? And then you've got, let's say, Audemars Piguet, good, better, best. If you got 10 grand, you buy a Tudor Black Bay. If you've got 25 grand, you buy a nice Rolex. If you've got 50 to 100 grand, you buy an Audemars Piguet, second hand. There's no point spending 100 grand on a Rolex, in my opinion, unless it's like a collectible rare Rolex, but really there's no point. So it's the same thing with cars, the same thing with everything. For example, and it can be lower level as well. It doesn't need to be exclusive. Like, for example, you have Toyota is a very good brand of car, very reliable. If you've got 20 grand, 30 grand, you buy Toyota. The moment you get to $50,000, I would argue that you might as well just buy an Audi or some German brand, Volkswagen, or something that's European, okay? Once you get to 100 grand, you might as well just buy a Mercedes-Benz C-Class, or, something like a 5 Series BMW or an A6 Audi. There's no point buying a Toyota for 100 grand. Like, there's nothing that Toyota can make that's worth $100,000. Now, this channel, and a couple of disclaimers before we get into this, because this is purely just my opinion of 30 years of investing in the Melbourne property market, number one. Number two, you don't need to agree with this. It's an opinion based on observation over time. The main objective of this video is to make money, because I believe some suburbs right now in Melbourne, in different parts of Melbourne, are severely undervalued for different reasons. And it happens all the time, and people just kind of forget that a suburb exists. Like, for example, there are suburbs in Melbourne which I guarantee you don't know where they're located, even if you live in Melbourne. For example, Ripponlea. Do you know where Ripponlea is? It's next to Elwood. It's a tiny little suburb. Did you know a suburb called Wishart? Wishart is located next to Bentley. There's many examples like that. Gardenvale, for example, which is Brighton. There's a lot of examples of little suburbs that are there, but no one even looks them up because they think, you know what, it's unaffordable, or I'm not even going to target those areas. The other thing that happens with good, better, best, for example, Bentley, Brighton East, and Brighton, is where people with, say, $2.5 million, they don't even think they can get into Brighton proper, so they don't even look. They just know that Bentley's, they can go better than Bentley, but they don't think they can go better than Brighton East. And there's been situations where there's houses in Brighton East and Brighton proper that are literally the same size, same block of land, same price, except you have a completely different suburb, you know? And that's a phenomenon that you can capitalize on to make money. And remember, this channel is purely about making money, nothing else. I've seen the same thing happen with Oakley, South Clayton, good, better, best. Okay, so you have Clayton, which is good, solid suburb, nothing wrong with it. I don't like it particularly. It's a bit semi-industrial. Oakley South, better than Clayton. And then Oakley proper, really good suburb, especially with the cafes and restaurants. I've seen situations where Oakley South and Oakley were virtually the same price for a townhouse, which I don't understand how that can even happen. And there's nothing wrong with Oakley South. I've sourced in Oakley South. But, you might as well you got to do your research, and you've got to understand this. Number one is this dynamic exists in everything with cars, watches, property, which are the main thing that I look at. Number two is you want to capitalize on this opportunity, because it's when there is a market inefficiency, that's when you can make a lot of money. And the property market constantly has market inefficiency in it for different reasons, and you can exploit that and make money. So welcome to today's video. It's going to be an interesting topic. Grab a coffee, grab a V drink, whatever your thing is. Let's sit back and relax and watch this video. Before we get started, disclaimer, this is purely for educational purposes only, and especially with this topic now, I'm going to talk about suburbs that are severely undervalued that I believe will boom in the next super cycle of 25, 26. This is purely my opinion only, okay? So I'm just going to share this information with you, maybe give you some thoughts about different suburbs you might have considered before as an investor, and it's up to you to do your research and due diligence and to work out whether I'm full of crap or whether I know what I'm talking about. For those who have never seen me speak before, about myself, I'm a real estate agent in Melbourne. I run Investors Prime Real Estate in St Kilda. I'm ex-mortgage broker, ex-private banking, ex-financial planning. I'm also a best-selling author. And probably the most important thing is that I'm a property investor, just like you guys, making money in the property game, revaluating properties, buying more properties, so I'm in the game. I'm not just a theorist. I'm not an academic. I'm making money, and I make more money per year in property than I do in my job. So I'm a professional property investor. I also want to really thank you guys for supporting me and buying my book. It's got #1 bestseller again on Amazon and other bookshops, which is really humbling, because when you launch a book, you don't know if anyone's going to be buying it apart from your mum and your grandparents. So I really want to thank you guys for buying the book, and especially my finance book as well. It's been #1 in various categories, including investments, real estate, buying, selling homes, etc., etc. If you want to grab a copy of those books, by the way, realestatemadesimple.com.au, you can get a copy there, or a digital copy, and also bookonfinance.com.au. That book is still phenomenal. It teaches you how to smash your mortgage in record time. So instead of paying 30 years, you can smash your mortgage in 10 or 15 years, depending on how clever you are and how well you use the methodology in the book. $30? I mean, well, there's nothing to talk about. Knowledge and action will make you into a millionaire if you implement, and over a period of time. So this took me 5 years to write this book. It's everything that I knew from private banking, from observing really successful property investors. Grab a copy and read it, and I hope you get really good results. Now, also what I want to do is give you a bonus online video course. All you got to do is scroll down below. It's worth $497. It's 5 years old, so 80% of the course is still 100% current. 20%, which is the market stuff, is completely obsolete, because obviously we've moved into a different market. But the fundamentals have never changed, guys. In the last 20 years, it's the same structures, same everything. So if you want to understand how investors are buying and building large property portfolios, 5, 6, 7, 8, 9, 10 properties, this is something you got to watch yourself, just to spend your belief when we're talking about interest rates and market cycles, because it is about 5 years old. So you just have to probably update that information and read or watch my latest YouTube video, because I do market updates constantly. Now, why invest in Melbourne residential property market in 2025? Melbourne is actually probably, in my opinion, the best investment opportunity right now, because the gap between the median price of Melbourne and Sydney is massive. And it's actually unprecedented. Normally, Melbourne property prices are just behind Sydney, and then there's Brisbane, Perth, and all the others, Adelaide, Hobart, etc. I don't know in what world Brisbane is more expensive than Melbourne. I mean, first of all, I know the reasons why, and I've done YouTube videos because we've been locked down for 2 years under dictator Dan, COVID-19, land tax, all the other stuff that happened. Victoria is a bankrupt state. It's got a lot of things that are negative around the state, but hey, it's the biggest capital city in not in the world, but in Australia, and also by urban sprawl, it's the biggest city. It's going to catch up to Sydney very quickly. So that gap between 1 million for Melbourne and 1.6 for Sydney is going to close very quickly, with or without you guys. So you just need to know which areas to target. Melbourne property prices tipped to hit record heights in 25, 26, bringing pain for buyers and boom for sellers. So we're going to watch this very quick video, which is just under 5 minutes, and I'm going to come back after that, and this gives you kind of an idea of what's happening in the Melbourne property market, just in case you don't know or you're interstate. Okay, so that's an interesting video about what's happening in the Melbourne property market, and that's also not incorporating the 5% no LMI first home buyers grant with no means testing, which is incredible. And I'm going to do a video just on that because when it hits in October, the market's going to boom, especially property prices in Melbourne under 950 are going to escalate. So this video is really good because it gives you an idea of the suburbs that are kind of overlooked, I guess, in Melbourne, and a lot of them are kind of under the 950 mark. Some of them are way over, but a lot of them are under 950 as well. One of the most significant things that we're going to experience is the cash rate, and being ex-banking, ex-NAB. I believe there's a huge correlation between interest rates, money supply, and property prices. And property prices are driven by the ability to borrow money and the appetite for borrowing money. And obviously people always want to have the biggest, best house they can possibly afford to live into. That's always been the Australian dream, the quarter-acre block with a house in it, with a white picket fence and a rose garden. Is that taking it too far? I don't know. That's been my dream anyway, and I got that dream, which is phenomenal. I've been very blessed with property investing. But I can tell you one thing: we had 13 interest increases because of inflation by the RBA, and the banks obviously jumped on board as well, which was unprecedented historically. Now we're going into the rate cut cycle, and we're also going to experience 5, 6, 7, up to 10 rate cuts in the next 2 years. Because when we have rate increases and rate cuts, you've got to kind of match what happened in the past. So I can tell you now there's going to be aggressive rate cutting. Inflation is under control, and property prices are going to go up even further, and rentals are going to go up. But the biggest thing for investors is these properties that I'm targeting for my clients are virtually cash flow positive or neutral because we're getting rental yields of up to 5-6%. If you bought off the plan from 2 years ago, so people coming out when these properties are actually being completed, getting 5-6% rental yield, and the cost of funding is, pretty much the same with negative gearing. They're getting money back in their pocket, which is incredible. And you're holding on to a growth asset in Melbourne, so it doesn't get any better than this. The key is to jump in at the top so you capitalize and you get the best potential scenario between the interest rate and the cost of funding. Melbourne house prices are lower than 5 major capital cities, which is just crazy. And this is unsustainable. As you can see there, Melbourne's the blue line. It's on the bottom. And we have Sydney, Brisbane, Adelaide, and Perth higher than Melbourne. It's unsustainable. It's going to catch up, guys. It cannot continue this way. According to Property Track, Melbourne's median dwelling values rose by only 19.2% in 5 years, thank you, Dictator Dan, compared to the average increase across combined capital cities of 45%. And you can see that the median price in Melbourne for houses is 983,000, and for Sydney for houses it's 1.564 million. And for units it's the same. Units are really irrelevant, but really if you look at median prices, it's just unsustainable. And how is Brisbane more expensive than Melbourne? Even with the Olympics, it's unsustainable. Melbourne's always going to be more expensive than Brisbane. So this gap is going to close very quickly in the next 2 or 3 years. And it's a great opportunity for investors to get in. But once again, Melbourne has 480 plus suburbs, and the suburbs being added every day, every week. New estates and they come up with these amazing names. By the way, if any suburb that you see has fountain or springs in it, don't buy it just on principle, okay? They usually end up being bad suburbs. So anything with fountain or springs or waters, not a good idea. Okay, it just means that it's bad. So that gap of 600,000 is going to close really quickly between Melbourne and Sydney. If you look at Melbourne and Sydney forecasted growth for 25-26, Melbourne is 6%, Sydney is 7%. So, we're going to go up by 66,000 in terms of property median price. Sydney is 112,000. Now, this is from Domain from 25-26. Now, remember, these reports are always super conservative. I mean, I remember in 2001, in the late 90s, 99 and then 2000, the market started to grow in Melbourne. 2001 went up by 22, 23%, 2002, 27%. No one forecasted 27% growth. I mean, even if you were super bullish, you would never say that, I mean, you just lose credibility. So in the industry, because it's a conservative banking industry, if you're bearish on the market, you're going to say 1 or 2%. If you're just neutral, 3 to 5 at inflation. And if you're super bullish, you're going to see 6, 7, and ultra bullish, you're going to see 9. No one even mentions 10% because it's almost like you're a spruiker or something. So you've got to understand with property investing, because it's dominated by real estate and the financial service sector, there's a lot of conservative people that don't like people saying anything over 10%. I think it's going to do 20% plus, and I've been right many times in the past. Domain is forecasting Australian property prices to jump to a fresh record high in 25-26, which is we're calling the super cycle, creating more pain for first home buyers. Well, yes, especially over 950 in Melbourne, because you can't get much in Melbourne from 950 and under. The average house in a normal suburb is 1.5, 1.6. Cotality, which used to be RP Data CoreLogic, has released the latest pain and gain report, which I recommend that you guys read and download every time they release it, showing 94.9% of properties resales made a profit for the seller in the March quarter, which is fantastic. So it's hard to sell and make a loss in property if you look at historical sales records. Over 90% of people that buy and sell make a profit. Which is really cool. So, once again, these are very conservative projections. Melbourne 6% for houses, apartments 5%, and then Sydney you look at houses 7% and apartments 6%. Apartments do okay in Sydney because really house prices are so expensive in some of these suburbs. You're either going to buy an apartment there or you can't live in the suburb. It's like Melbourne's Toorak and Hawthorn and Kew, for example. For a lot of people, you've got 2.5 million, you can't even look at that suburb for houses. So apartments are the only option you have in some of these suburbs. And once again, this is apartment forecast for Melbourne, 5% for Sydney, 6%. My advice is don't touch apartments in Melbourne. There's a lot of issues with quality of control, of a build quality, I should say. There's a lot of cowboys building apartments in Melbourne. They're cracking. They've got water damage in car parks. It's a nightmare to fix. The cladding issues that we've had in Melbourne, people have spent tens of thousands of dollars fixing cladding because of new compliance laws, and just dealing with owners' corporations overcharging you. I mean, you look at Today, Tonight, Current Affairs, Four Corners, ABC. There's hundreds of stories of people buying apartments to retire into, whether it's Queensland or Melbourne or Sydney overlooking the water, and it becomes, their dream becomes a nightmare because of the owners' corporation overcharging exorbitant fees for managing the strata and the common land. So if you can get a house or a townhouse, it is a much better option from an investment perspective and from an owner-occupied perspective, in my opinion. So yeah, once again, meanwhile, Totality from CoreLogic has released its latest pain and gain report, talking about people making a profit. So, the average profit has been around $300,000, which is cool, which is a nice profit. Imagine trying to save $300,000 after tax. It's just not going to happen. So property is a really good vehicle. If you can multiply that and create a system that is sustainable around making chunk deals or making equity and then drawing against it, that's the way you want to get wealthy. So profit, very good, 94%. I mean, imagine in the stock market if 94.9% of people made a profit trading shares. I mean, it's unheard of in any other sector. Melbourne house prices are tipped to boom in 25 and 26. So here's the interesting thing. We're in the rate cut cycle right now, and this is historical data showing you house price changes in 2 years following the start of a rate cut cycle, which is a sequence of cuts that are occurring, which we're at the beginning of one now. So, and this is really interesting data. So in 84, we had the market boom by 6%. Not really a boom, it increased. Mind you, in 84, in the 80s, the market was negative, so that was actually quite a good result. In 86, 11%. In 1988, 60%. Good, not a bad result. 92, 5%. 98, 15. And remember, in the 90s, we had negative gearing rolled back. We had the introduction of capital gain tax. I mean, property investing was very negative in terms of getting results in the 90s in Melbourne and Sydney. In 2003, 32% growth. 2010, 15, 2013, 13, 2017, 12. And then in 21, we had 27% capital growth, which is interesting. So we're going to see that again. We're going to see a substantial uplift in median prices for properties following this rate cut cycle opening up wide. So it's going to be very interesting. House price predictions, if rate cuts by 1.5%, combined, which could be a sequence of 0.25% or 0.5. So in Sydney, you're looking at after the cuts, the market's going to go up by 12%. Which means it's going to go from 1.69 to 1.89, nearly 1.9. I mean, it's going to go to 2 million very quickly in Sydney. It's just a question of when. Look at Melbourne in terms of value for money, 1,035,000, and it's going to go up to 1.16. I think it'll go to 1.25, and then it's going to go up to 1.5. If you look at Melbourne and Sydney, the wages are very comparable in Melbourne and Sydney. We have the same technology sector, the same commodity sector. We roughly have the same amount of legal and marketing firms. So in terms of disposable income, we're probably around 10, 15% lower than Sydney, but it's very on par, especially with those high management jobs. But look at the difference in the median price differential between Melbourne and Sydney. I mean, it's 1 million versus 1.7. It is crazy, guys. 600,000, 700,000, depending on which source of information you're looking at. This is Domain. There's different sources of data, which I've covered in my YouTube channel in some other videos. And Brisbane is nearly the same as Melbourne. And in fact, in some weeks, it's higher than Melbourne, which doesn't make sense. I think it's overpriced. I don't think there'll be a correction, but I think it will stagnate as Melbourne takes off and catches up to Sydney. And so it's going to be interesting time in the next 2 years if you position yourself in a specific area to take advantage of what's about to happen. I often hear this term, oh, but it's so expensive in that area. There's a reason why it's so expensive, because it's good. And people have this fallacy thinking that it's so expensive it can't go on, where most expensive suburbs don't have mortgages. People pay cash for properties. And so Melbourne's prestigious suburbs are outperforming the rest. Have a look at these areas and the growth over 5 years. This is from Domain. So Baldwin North, once again, Baldwin is not Baldwin proper. Baldwin North is just under Baldwin. Baldwin North, median price 2.25 million and 5-year growth 26.4%, which is still virtually double what Melbourne did, despite all the lockdowns, despite everything. So I want to show you, even during bad economic times, which is the last 5 years in Melbourne, from 20 to 25. So from COVID-19 to now, the prestigious suburbs have still done really well, because there's always rich people around. There's always successful people around, middle management, entrepreneurs, company owners, and they don't care about what's happening in the world. They just have money and they know what they like and they're going to spend it, and that's it. So Surrey Hills, great suburb, 26.3%. Eaglemont, fantastic suburb, 24.5%. Hampton, I've done a lot of stuff in Hampton, 24.4%. Blackrock, I love Blackrock, 23.8%. Hawthorn East, yeah, not bad, 22.6%. Camberwell, always great, 22.5%. Baldwin proper, 21.6%. Hawthorn, 18.3%, and Malvern, 17.7%. It's interesting because Baldwin has done 21.6%, Baldwin North, 26.4%. It's a perfect example of good, better, best, because Baldwin is superior to Baldwin North, but it's actually a higher median price, 2.8 versus 2.25, but it's done better. And that's what this video is exactly about. Melbourne rents are booming in 25, so rents have gone up by a huge amount. Some areas that I've sourced properties in Melbourne, especially on the beach, rents have gone up by 30 to 40% in 1 year. Carnegie, for example, which is not a beachside suburb, Carnegie has gone for the average townhouse that I've sourced for 1.2 to 1.5. Rents have gone from 850 to 1,200 a week in 2 years' time, which is like off the charts. Richmond's another area. Alphington, I've sourced a lot of townhouses there. $200 increase in 2 years, 100 a year. So, these areas, people think they're expensive. They're expensive, but remember, expensive areas attract expensive tenants with disposable incomes that are very high. They can afford to absorb the increase in rental. Cheap areas attract cheap tenants. They have no money, that are broke and probably going to be problematic. So these are the areas in Melbourne where rents rose the most, which is really cool. This is for the June quarter. So I just want to show you how good rents are going up in key areas. Edithvale, big fan of Edithvale, 20%. Hyatt, not bad, 17.1. Campbellfield, wouldn't touch it, 17%. Mont Albert North, fantastic area, 15.9. Heidelberg West, I've been sourcing a lot of stuff in Heidelberg West, 15.4. South Kingfield, don't like it, 14.5. Carrum, yeah, not bad. Carrum was good 10 years ago. Now, I don't like Carrum. I stop in Edithvale, Aspirational, Bond Beach. I don't go to Carrum or Seaford. I just think they're too far out. 14%. Meadow Heights, who cares? 13.3. Upway, not really an area to invest in, 13%. Ashburton, fantastic, 12.6. Fairfield, yeah, okay, 12.5. Lilydale, good area, 12.5. Hampton, 12.3. Ivanhoe, fantastic area, 12.3%. Forest Hill, sleepy, but not bad, up and coming, 12.3. I don't even know where this suburb is, so I'm going to skip it. It's probably some new estate. Yeah, Macquarie, no one cares. Keilor Downs, don't touch it. Moorabbin's actually really cool because Moorabbin is an area that is very industrial. It used to be Moorabbin, Bentley East, and Bentley. Good, better, best. So good is Bentley East, and Moorabbin. And Moorabbin used to be the arse end of the bayside, southeast kind of area. It was, especially next to the airport, next to DFO. Moorabbin used to just be shit, let's face it, right? There's nothing going for it, especially the part next to the Crown Golf Course next to DFO. It was semi-industrial. There's car yards between your house. There's this kind of weirdness happening where there's like old factories. There's an industrial estate in Moorabbin. But all those industrial estates now are shutting down, and you have these old guy that was making some aluminium windows somewhere or doors. And the kids are probably in McKinnon High, in Bentley. They're all doing, dentistry and medicine. No one wants to work in those factories anymore. Kids just want to be influencers now, on their phone going, yeah, what's up, what's happening, all this kind of bullshit. No one wants to work in the factory anymore. So they're shutting down those factories and they're changing them into wine bars, burger places. So I'm a huge fan of Moorabbin. I think Moorabbin is severely undervalued. I think it's going to become the coolest suburb in about 10 years' time. It's already becoming really cool. There's all these little hidden pockets in Moorabbin of burger joints and wine bars and really cool places. But I am a big fan of Moorabbin. It's going to be a really interesting suburb. And so if you're investing in the Bayside, just do your research, and it's super cheap right now. So I'm not surprised rents are going up fast. Mount Evelyn, great area, 11.8. Taylor's Hill, 11.8. Not really, it's a family area. It's not really for investing. Melbourne's western suburbs are starting to take off. Now, I've been sourcing a lot of the western suburbs because they were cheap during the COVID-19. They got hit the hardest in Melbourne. A lot of factory workers which work in the west weren't able to work because the factories were all shut down. So people were home, and therefore there was a lot of negative impact on median price movements in the area. So Altona has gone up by 24.1. Altona is a great area. It's got a new house and land estate in Altona North. I'm a huge fan. Newport, 19%, which is really good growth. Altona North, which has one of the best estates, Haven, 18.8%. Probably the best, my favourite estate in Melbourne is in Altona North, which is a really good estate called Haven. Seddon, yeah, I'm not a fan of Seddon, 14.6. Yarraville's phenomenal. I've always been sourcing in Yarraville since I started the company. I think it's undervalued severely, 13.1%. Williamstown, the oldest suburb in Melbourne, phenomenal suburb for capital growth. You can get anything because everything's heritage protected. So it's hard to buy into Williamstown, 11.9%. This is for capital growth, by the way. Footscray has a lot of issues demographically. It's not a bad suburb. It's going through gentrification, but the gentrification is going sideways at the moment. So the crime in Footscray is off the charts. Police are shooting people in the streets. There's been recently 2 shootings just this month. If you Google it, you'll find them. Sunshine North, great fan of Sunshine North. It's going through gentrification really well. So I'm not surprised the capital growth has been 10%. And West Footscray, same thing, really rough, 7.9. Maidstone, but I'm not a fan of Maidstone, wouldn't touch it, 7.3. Melbourne suburbs where house values rose most over 20 years. So before I show you the undervalued suburbs, I just wanted to show you areas where there's consistent growth, because I'm a big fan of having a really boring strategy when it comes to property investing. My theory is, and this is just my theory, that if your investing is exciting, you're doing it the wrong way. Investing should be super boring, predictable, number-based. I talk about falling in love with the numbers, not the property. The money that you get out of investing through a line of credit or redraw facility, you can use to buy really cool stuff, right? Exciting things like holidays, cars, do charity work, whatever your thing is, right? But the actual way you go about investing should not be exciting, okay? It should be just boring and predictable. So if you're doing exciting investing, my suspicion is you're going about it the wrong way. But these are the areas that I think are the most important areas, and they've gone up over 20 years. So if you want to park your money without getting too risky with it, stick to these areas. That's the only reason I want to show you these areas, because they're going to continue exactly what they're doing. And I source a lot of properties in these suburbs, and they're the best suburbs in Melbourne, full stop, for capital growth. Q East, number 1 suburb, 349.5% growth over 20 years. Now, people always see that and go, but is that going to continue? Yes, it will, because the rich are getting richer and the poor are getting poorer. See, Donnybrook, I don't even like, I've never sourced in Donnybrook, but it was so ridiculously cheap when it started. It was just cow paddocks with nothing there. It was the cheapest subdivision in Melbourne at one stage, that it had to go up in value, because now all it's doing is it's just going up to a really bad suburb value. So cheap and so ridiculously bad and cheap, now it's going up to average bad and cheap. If that makes sense. Don't invest it. Bowen, phenomenal, 324.2% growth. Bowen North, 315. By the way, with Donnybrook, don't send me emails. I know that stage 1 of the estate was super cheap. And if you invest in stage 1, hold on to the land and sell it. But then what happened in Donnybrook is every taxi driver in Melbourne was selling blocks in that estate. So, it was on Facebook and Gumtree, there was hundreds of blocks for sale. So I don't want to hear about Donnybrook, okay? I know all about it. I will remember when it was launched. Bowen, phenomenal. Bowen North, great, 315%. Cobblebank, I don't even know what that is. It's probably like a new suburb somewhere, and someone just made up the name. And it doesn't matter where it is, because no one knows. If I don't know about it, it doesn't make it. It's irrelevant, because I'm sourcing properties all day long. Okay, Donnybrook once again. Victoria as a suburb. Mickleham is bad, don't touch it. St Kilda, phenomenal, 288%. Balaclava, great. Notting Hill, fantastic. Dippendy, fantastic. Surrey Hills, Camberwell. Doncaster East are very undervalued, 272% growth. Kilcullo is horrible, don't go there. I don't even drive your car through that suburb. Hawthorn East, phenomenal, 261%. Hawthorn proper, even better. Probably the second best suburb in Melbourne, third, depending on Toorak, Hawthorn and Brighton. Ashburton, great suburb, undervalued, 256%. Essendon North, and fantastic. Cube, great. Hampton East, phenomenal. Mount Waverley, Glen Iris, Canterbury, and Burnside Heights, don't touch it. So there's some suburbs there that have just gone up because they're so good, the more expensive ones. The cheap ones you've got to be careful with, because if you've got a cow paddock with nothing on it, and you do stage 1 and stage 2, and you sell the cheapest possible houses for 280,000, and the land is like 150 or 100, right? So your house and land package is for 400,000, which is Donnybrook effectively. Then yeah, you're going to have high capital growth, because there's other house and land estates like Berwick, Pakenham, for example, or Point Cook, Trigonina, Tunneet, that are already at the $600,000-$700,000 level. So you're going to catch up eventually, but they themselves don't really do well. So you're going to catch up, and then stagnate, because Berwick and Pakenham have a lot of infrastructure and things built into those suburbs. Those estates are very old estates. I mean, there's old Pakenham and old Berwick and new Pakenham, but Pakenham New has a lot of schools. There's a lot of stuff already built there, shops, shopping centres, and these new estates will take years and decades to catch up. So I'm saying it's a trap. That's why you've got to do fundamental analysis backed up by technical analysis. If you just do technical analysis, which is just looking at this and go, oh, I'm going to put money into Donnybrook because number 2, it's affordable, you're not going to make money. You're going to make a massive mistake and lose money. So this is the difference between people that do fundamental analysis and technical analysis. Remember what Warren Buffett says, which is the most successful investor of all time. Berkshire Hathaway is returning around 25-30% per year since inception. Beware of geeks bearing formulas. And what it means is beware of people doing technical analysis. Warren Buffett does fundamental analysis, and that's why I subscribe to. But hey, it's just my opinion. Don't take my word for it. Yes, it's always nice to buy at the bottom of the market, which is where we are now in Melbourne. That's not the most important thing, though. The most important thing is to buy based on fundamentals. People always go, I want to buy at the bottom, and they go and buy Donnybrook, and then they have no money. 5 years later, it's stagnating and just barely keeping up with inflation. So yes, it's always nice to buy at the bottom, but I would rather overpay for a good asset than underpay for a bad one, which is exactly what Warren Buffett says. So here are my best 3 undervalued suburbs in Melbourne where townhouses will boom in 26, 27. Now, I've got 3 categories because I can't just put them all together into one category because prices are so different. I have the expensive category that I'm going to go into first. Then I've got the mid-range, and I've got the affordable category, okay? So I've kind of separate them because you can't merge them together. Now, before we get into them, what really determines capital growth long-term is what I call the lifestyle triangle, which is the distance it takes for you to travel from home to work to school and back home. And so if you're living in Bentley, working in Bentley, your kids go to McKinnon High School, you're going to be traveling to work from home to work 5 minutes, from work to pick up kids 7 minutes, and back home, you're going to have a good lifestyle triangle. If your home is in Bentley and you're working in the city and your kids are going to school in Pakenham, you're going to be on the road for 3 hours a day, you're going to be miserable, okay? So people pay for convenience, and there's obviously supply and demand. There's other factors. There's actually 46 due diligence criteria that I have. But fundamentally, it's a distance from the city and distance from the water, which is what Melbourne is priced on. And also people pay a premium for having a good quality life, and they'll pay a premium for the suburb having amenities accessible. Now, if you want to know more about this topic, check out my video on top 10 fundamental things you must know a suburb has before you invest there, which talks about the top 10 things, which is supply and demand, future stock, DSR ratios, all those different factors that you got to be aware of. But for the purpose of today, let's just stick to the fundamentals. So these are the 3 best expensive undervalued suburbs in Melbourne right now to buy townhouses in that are going to boom in 26, 27. And potentially 25, 26, but definitely 26, 27. Ashburton, Baldwin North, and Glen Iris. And the range is between 2.395 to nearly 3 million. Now, this is where they're located. So if you look at Ashburton, postcode 3147, it's in the kind of southeast section. This is an example of a property that I've got access to in Ashburton, which is, and I can source in any suburb, by the way. That's what I do. By the way, people ask me how I make money. I'm a real estate agent. When I sell these properties, I engage the developer and builder. I get paid commissions from developer and builder. I'm also a buyer's advocate, but I don't do buyer's advocacy. Buyer's advocates will charge you $30,000, 15 and 15 upon signing and 15 at settlement. What I do is I'm a normal real estate agent, but I source only from developers and builders in key areas that I like. So I don't charge you anything for my services, because I have had a lot of people saying, how do you charge? Are you a buyer's advocate? Yes, I'm a buyer's advocate, but unlike buyer's advocates, I don't charge you for my services. Like a mortgage broker doesn't charge you for writing a loan. The banks pay the mortgage broker, which I used to be. So I've got the same system set up with my property. So when you source from me, you pay me nothing. There's no fee at all, 0. So why is Ashburton good? Well, you look at the fundamental factors. Victoria's top primary school and sought after VC ranked Ashwood High. You got Moments Away. You've got, so in the school zone, you've got the Solway Primary School, top 96 TR score. So you've got the schools. I'm not going to go through everything because we'll be here for 5 hours. You got, 7 minutes to Caulfield Grammar School. You've got Deakin University around the corner. So connectivity is second to none. You've got the train stations, and then you've got the shopping centre. You've got Ashburton Shopping Centre, Chatston Village Shopping Centre, the fashion capital of Australia. Then you've got all the parks and beautiful grounds. And these are quite substantial, by the way. It's a family area. Ashburton is a family area. It's not a yuppie area. It's an upmarket family area. So you need houses, basically. So this is a 4-bedroom, 3-bathroom, 4 toilets, double garage, or one tandem space, another garage. You can see they're very large, 4 bedrooms plus retreat. They're over, 30 square meters. So their combined is, looking at probably 250 square meters of living area. Same with this property here, number 2. There's only 2 on the block. So it's a duplex. This one's a double garage, has a bedroom downstairs with walk-in robe, ensuite, open plan living, courtyard, pergola, and upstairs you've got the master bedroom with walk-in robes, another 2 bedrooms with en-suites, an oversized en-suites for the kids. So these are 4-bedroom, 3.5 bathroom, double lock-up garage, and single garage plus off the street parking, 2.7, 2.695 off the plan. So, and this is a typical product you have there. Bolwood North, phenomenal area. It's another grey area. So Bolwood's booming. Bolwood North is undervalued, I believe. So Bolwood, once again, this is Doncaster Road in Bolwood. Once again, phenomenal schools. You've got the connectivity. You've got the buses, the trains to the city. You've got the shopping. You've got Doncaster Shopping Centre, probably my favourite shopping centre in Melbourne. I don't like Chatston, it's too big. Chatston is ridiculously big to the point where you go to Chatston, and I end up there once a year somehow. I don't know why, usually at Christmas, and I go, all right, I had enough. Where's my car? And I look at my iPhone. Your car's like 3 kilometres in that direction. Like you have to catch a taxi to you. It's so big, you got to catch a cab to your car. It's like 3 kilometres in the other direction. So it's become, Chatston, the shopping centre is ridiculous. It's like a suburb. It's too big. Doncaster is manageable and it's brand new and it's really European. And you got all the schools and medical centre and parks. Once again, you've got a substantial, almost like a mini home, double garage, 4-bedroom, 3-bathroom, bedroom downstairs with walk-in robes and ensuite, open plan living, kitchen island, bench top. You've got a pergola, you've got a decking, you've got a wraparound garden, and then upstairs you've got 3-bedroom with 2 ensuites. So that's only 3 in that development, and it's a common land. So you do get all the stamp duty discounts, 1.445 and 1.8. See, something like 1.445 for Bolwood North, I think that's really cheap. They will go to 1.65, just nothing. So it will take no effort at all for that property to appreciate in value. Glen Iris, well, always top 10 suburb. It's undervalued now because Toorak has taken off so much, and Melbourne. I think people have forgotten Glen Iris to some extent, which they shouldn't because it's a really expensive suburb. We've got a lot of properties in Glen Iris. I'm a big fan. I mean, beautiful suburb. You've got Chapel Street down the corner. You've got all the schools there. I'm not going to go through all the schools. Connectivity to the city, connectivity to train, highway. You can get to the city in about 12, 15 minutes. Shopping is phenomenal because you've got the Chatston Shopping Centre, you have Toorak Road Shopping Centre, you've got Chapel Street down the road, surrounding parks, medical centres, Cabrini, Melbourne, you've got all the mini medical centres around there. Phenomenal. This is a really good project that I have access to, which has 4 bedrooms, so double garage, and then you have on the ground floor open plan living, kitchen, island, bench top, plus you have a bedroom with an ensuite, walk-in robes, and then upstairs you got 3 bedrooms with 2 ensuites. Master's probably upstairs with the walk-in robes. Once again, 2.25. For Glen Iris, that's nothing. I mean, and this in Melbourne will be 2.7, and in Toorak will be 3.5. So I think Glen Iris, even though it's an expensive suburb, is severely undervalued right now for townhouses. This is the aspirational undervalued suburbs. So these are kind of more down-to-earth, affordable suburbs. Brighton East, Box Hill South, and Doncaster. Now, a lot of people say Brighton East, well, that's expensive. Yeah, but it's undervalued, I believe. So Brighton East at one point was sometimes as expensive as parts of Brighton, but now there's a huge gap. This is an example of a completed property in Carr Street in Brighton East. but I get properties in Brighton East all the time. I'm sourcing there constantly for my clients. And once again, I think it's the best part of Melbourne. You've got Brighton Secondary College, you've got so many, you've got Furbank, you've got all the private schools which no one can replicate. You've got great shopping, Church Street, Bay Street, you've got Centre Road in Bentley around the corner. You've got shopping centres, you've got Southland and Chatston, you're between two shopping centres. Massive amounts of surrounding parks. City, 25 minutes. On Beach Road, if you catch the highway, probably 20 minutes. Train, same, 15, 20 minutes. But just the quality of life is phenomenal. It's just one really nice part of Melbourne. Something like this, double garage, and then you've got open plan living downstairs. And then upstairs, you got 3 bedrooms. You're looking at kind of, 1 million, 1.295 to 1.6. Now, in Brighton proper, this would be 700 to a million above that. So, you're getting huge value for money. And that's why these suburbs, even though they're expensive, they're undervalued, relatively speaking, towards surrounding suburbs. I think Brighton East at the moment is severely undervalued, and it's going to go crazy in the next property cycle and catch up and surpass some areas of Brighton. Now, Brighton, once again, there's not just Brighton. There's Beachside of the Road. There's the Golden Mile. There's St Ninians Drive. There's North Road. They're all very different pockets. There's Middle Brighton. So every part of Brighton, it's a huge suburb, has a different dynamic. But I think in terms of value for money, Brighton East right now is really undervalued. Mid-range suburbs. So we're getting cheaper and cheaper as we're going down. So these are 1,085,000 to 1.495. Burwood East, Mount Waverley, and Doncaster East. So Burwood's really expensive. Burwood East, people have forgotten about. It is semi-industrial. It's really good value for money. Same with Mount Waverley. Glenlary's booming. Mount Waverley, and then Doncaster's booming and Doncaster East is undervalued. I won't go through, I've got properties in all these suburbs. Croydon East is the same. Croydon's booming. Croydon East, people forgot about. Reservoir's really undervalued, and Altona has boomed. Altona North has been forgotten about. There's a new estate in Altona North, which is really, really good, which is Haven, and I'm a big fan of it. I think it's going to do well. It's 11 k's from the city. Can you imagine a house or land estate 11 k's from the city in Melbourne under $1 million for 3 and 4 bedders? I mean, how is that sustainable? This is Reservoir. Reservoir used to be a very, very blue collar, I wouldn't say dodgy suburb. It's never really had the crime, but it was just a rough kind of, area where, like Bayswater, it was just kind of these areas where you just, people go, where? Reservoir? Oh, gee, okay. It's come up pretty well. The redeeming thing about the area was there's a lot of parks, very mature trees, and large blocks of land. And trees make the streets, and they have very wide streets in Reservoir. So now they're ripping down all those old houses from the 70s and 60s and putting up brand new townhouses. A lot of kids from the area are moving to Reservoir. They can't afford, in their own suburb where they grew up, because Reservoir is the cheapest in the area. It's kind of north, but it's very good. I mean, it's very affordable. Fawkner is expensive, Brunswick's expensive, Reservoir's kind of cheap now. So I'm a big fan. I think you can do very well there. To give you an example, and you've got the, universities, you've got the medical clinics, it's not suburbs, so you've got everything there pretty much. This is an example of 247 Spring Street Reservoir, and kind of a townhouse like this, which is off the plan, it's just nearly completed. And very kind of turnkey, low maintenance garden, 765,000 for 2 bedders, and 3 bedders go for probably around 850. So you're looking at really good value for money in a really nice leafy area with okay schools. I mean, and this is part of Melbourne. So in terms of Reservoir, I'm a big fan. I think it's going to do really well. I think the demographics are right. It's got a good mixture of different nationalities in the suburb. It's got good shops already. A lot of the shops are converting into gyms and cafes for the first time, and they used to be like just dodgy retail shops. Scoresby, Croydon North, and Wanturna. Yeah, once again, these are super cheap, undervalued suburbs in Melbourne, and they were really rough at one stage, but they weren't rough with high crime. They were just very much low income, blue collar factory workers, people with low incomes. There was nothing wrong with these suburbs. Montana's never had anything wrong with it. It's not Dandenong, which is rough, or St Albans, where it's all gangs, and you get stabbed. Montana's just always been a sleepy, boring suburb. But I think Montana's doing really well now. I think there's property prices, houses starting for 1.5 million, townhouses are going for 700,000. It's a really good area. So Scoresby, Croydon North, Montana, great suburbs to look at. I think they're severely undervalued right now in Melbourne. If you're looking for gentrification suburbs, without question, Heidelberg West, Heights, and Sunshine North are the best three suburbs for gentrification. If you're looking at gentrification, what is gentrification? A lot of people mistake gentrification for rejuvenation, which is very different. Okay. Gentrification is where rich people go into a poor area and displace poor people. It is very specific. It's not just people slowly moving into an area. It is literally they're in. So it's these people going into this person moving in. Now that person on the right-hand side, he can go anywhere he likes. So there's got to be specific things about the suburb that make it attractive to yuppies and high-income earners for them to go in. Because remember, they can go anywhere. They can go to a normal suburb if they choose to. So what would make someone, let's say on 150 grand, go into a suburb where there's this guy on Centrelink, smoking dope all day? Like, what would make that person go into? That's gentrification, guys. It's not just rejuvenation. Rejuvenation and gentrification are two separate things. So gentrification is the process of changing the character of the neighborhood through the influx of more affluent residents and businesses. It's a common and controversial topic. It's very controversial because I feel sorry for the people that were there originally. They get displaced and they get priced out of the market, both in buying properties and the rental market. Gentrification increases the economic value of the neighborhood, but results in demographic displacement, which becomes a major social issue. So I'm not justifying gentrification from a social perspective. This channel is about making money, not about social commentary. Gentrification sees a shift in neighborhood racial or ethnic composition and average household income as houses and businesses become more expensive and resources that have not been previously accessible are extended and improved. So which tenant would you like to live in your property if you had a choice? And that's what happens. That's happening right now in Heidelberg Heights, Heidelberg West, Belfield, and Sunshine North. These guys are moving out and these guys are moving in. And it's an interesting thing. Now, a lot of people can't see it. They don't believe it. They'll believe it when it's 70, 80% gentrified. Now, the thing is, when's a good point to come in? See, Altona North, I would say Altona Beach has always been really good, but Altona and Newport were going through gentrification 15, 20 years ago, and people didn't believe it. Now they're buying in there, but the money's already been made multiple times over. So you got to have the right set of eyes and due diligence capability to identify before it starts off. But there's a danger that what if he doesn't gentrify all the way? Because there are suburbs in Melbourne, I'm going to do another video in, where they were supposed to gentrify 20 years ago and they're still crap. It just didn't happen. It's just like, oh, it's gentrifying. And there's all these stories about how much money they're spending from the government, the county, local government, state government, and it's still rubbish today. People have bought in there, they've been waiting forever. And the opportunity cost of going into an area that doesn't end up gentrifying to the extent that you want it to is a huge loss of money and time. And this is the thing we want to avoid. So we want to make sure these tenants here move out and these tenants move in, because they have different lifestyle, they're responsible people, they have nice cars, nice furniture. Now that the neighborhood is nice, why do I have to move out? That's what happens with gentrification. So I'm not condoning it, okay? Don't judge me. I'm just observing it as a phenomenon and trying to make money out of it. I'm not making gentrification a reality. Okay, I'm just saying it's happening. It's going to happen with or without me. Should I put my money in there? That's what I'm trying to kind of inspire you guys with. Now, these are some of the gentrification suburbs in Melbourne that have occurred, which is the dark blue patches. So you have northeast, you've got Collingwood, Alphington, Fairfield, Heidelberg, East, West. Heidelberg proper was never gentrified. Preston, East and West, Reservoir, East and West, Fawkner, Coburg. I mean, Coburg used to have Pentridge Prison in the middle of the suburb, with all the girlfriends and wives around there renting and bringing drugs into Pentridge. No, not a good area. Pascoe Vale, Essendon, parts of Essendon. Essendon is really upmarket, but it's still gentrified, those parts of it. Southwest, Footscray, Seddon, West Footscray, Braybrook, Newport, Altona North, Sunshine, Sunshine West, Sunshine North. The best area of that is, of course, the closer you get to the city with these little pockets here. So, this is why my number one capital gentrification suburb to invest in for 25 and 26 in Melbourne is definitely Heidelberg Heights and West and Belfield. I mean, they're pretty much the same suburb, they just have different names. They're in the southeast kind of area, so they're surrounded by really affluent upmarket suburbs like proper Heidelberg, Ivanhoe, Eaglemont. They're in the hospital precinct, so there's the Austin Hospital. There are a huge amount of things going for it. And the number one thing about these guys is if you go to Heidelberg Heights and West and Belfield, the first thing that strikes you is the quality of the parks and the trees. Remember, this area was built up in 1956 for the Olympics, but it was already an older area. It had already established trees, and you can't build new trees in new estates. This is the problem with Beveridge and Wallen Wollert. You can't have European trees built there because it'll take 100 years to grow. That's why new estates look so barren. It's just houses or rooftops, not one tree in sight. Now, eventually, they come up. Like South Morang has come up, for example. It was just cow paddocks originally, and now there's the main boulevard and the streets off there and the little creek there, which you can never see it. It's just literally like a little line of water. That has now established trees all around there, and it's starting to look like a normal suburb. But Heidelberg Heights and West especially, they were rough, very high crime, low income demographics, but they had very good parks and trees and amenities. It's the cheapest area surrounding by very affluent suburbs like Rosanna. So you look at the median price of properties. This is townhouses and houses in the area, 890 versus 1.2 million for Rosanna. Heidelberg's 1.4, Eaglemont 2.3, nearly 2. I would say 5. Ivanhoe 1.7 and Thornbury 1.4. That little gap here in between is actually Belfield, which is about 950 for the median price. It's 12 k's from the city, and you can get really good value for money. You got La Trobe University, 40,000 students putting pressure on the rental market. There's no correlation between university campuses and capital growth, by the way, because most university campuses are just foreigners. They never buy property, they rent. So they drain the rental market, but they never end up buying anything. You can see that in Heidelberg, you have the medical precinct here. So you got the Austin Hospital, the Olivia Newton-John Ward Centre, the Warringal Private Hospital. You've got all these hospitals there. You've got something like 15 to 20,000 doctors and nurses just in that little concentration. And the rest of the area, like Rosanna and McLeod and Eaglemont, they're all detached houses with pools. So, if you're creating a product for them to rent, these people don't want a big house with a pool because they can't afford to rent there, and they don't want to have a big property to maintain. They want a brand new townhouse. They want a bedroom and an ensuite, maybe a little backyard, low maintenance, brand new. And this is exactly what this product is. So the Austin Hospital is a huge draw card for the area. The shopping centre is pretty average. It's really tired looking now. We should have rejuvenation soon. 330 shops. Definitely Burgundy Street's got really nice restaurants and cafes. Vacancy rate below 1%, 0.62%. Very good capital growth, very good income demographics. You got 3 train stations, you got the buses as well, and they're spending about $5 billion on business centres there in Heidelberg West. The building, all these buildings for startup companies, and where you can come in, have a hot desk or an office, or you can run your company from there. So it's going to be kind of a big hub for entrepreneurs and people that want to start up businesses, on a string shoe budget. It's an excellent area, and you can get properties there. I would say 3-bedders. This is sold out now, this project. 900,000 for 3-bedders. 4-bedders are going between 950 to 1,050,000. Turnkey, landscaping included, everything. Some of them have owners corporation. Some of them have no common land, so they're separate blocks of land. Like this one, for example, has no common land. It's just 4 townhouses built. 235 square meters, 4-bedroom, 3 bathrooms. You're looking at just over $1 million. They rent for 900 a week. Very good rental, very good capital growth potential. I get these all the time, by the way. So if you're interested in securing one of these, just drop me an email or give me a call, and I'll send you out information. If I was spending $1 million in Melbourne right now, I'll be putting into Heidelberg Heights West and Belfield without question, because the eastern suburbs have all the money. You can't get into the Bayside for $1 million unless you go to Mordialloc, which is okay, but it's 25Ks from the city. This is 12Ks. This is as close as you get to the city with a four-bedder for $1 million in the right part of the city, surrounded by really upmarket schools and suburbs. So to me, if $1 million, if you've got $1 million or 900 to $1 million, you don't know where to put it, Heidelberg Heights West, Belfield. If you got 750, Sunshine North, definitely. If you got 800, Altona North, definitely. I hope that's it, guys. I hope you were inspired by this video. I hope it kind of gave you some food for thought about different areas you might have considered investing in Melbourne. I've also gave you some warnings there of areas where you don't want to you want to avoid, like a Teen Arena concert, like Donnybrook, Beveridge, Mickleham, all those areas. All the North Corridor is a complete disaster. I'm actually going to do videos about why those areas are so dysfunctional. And it's not me. I'm going to show you videos of the locals complaining how bad it is and how many people have bought into those areas. Owner occupiers are trying to get out. Investors can't rent out their properties because there's 700 houses for rent and no one wants to rent there because it's a first home buyers kind of an area. But if you're interested in learning more, by all means, get yourself to my event called the Real Estate Investing Fast Track Weekend, which I run in my St Kilda office from time to time. Just check out realestatefasttrack.com.au for the latest dates. Tickets are $47, and you get a hard copy of my book, Australian Real Estate Investing Made Simple, which is like a manual for the 2-day event as well. So that's a really good event to attend. If you can't attend the event, I'm going to give you a free gift. All you got to do is scroll down below, access an online home study, which is worth $497. You can watch that right after this video, with no strings attached. Also, if you're interested in working with me personally one-on-one, you book yourself in for a 60-minute strategy. It's free. There's no strings attached. We'll sit down. We'll jump onto Zoom. I'll go through your situation. I'll work out where you are, where you want to be, and I'll show you how to bridge the gap between you and where you want to be financially. The idea is to develop a plan, an all-encompassing plan around property acquisition, and you're going to walk away from this with a real sense of understanding of exactly what options you have available, how much money you can borrow, what kind of properties to target. Remember, if you fail to plan, you plan to fail. A lot of people waste so much time getting from A to B. And remember, you can always get more money, guys. You can't get more time. Once your time runs out, that is it. So if you want to fast track your results and work with professional people like myself and my team, I'm here to help you. I'd love to catch up with you on Zoom or a coffee in St Kilda anytime. Just let me know when you're available. You also get not only your strategy in writing, you can walk away with a whole team. So if you need a good accountant, good solicitor, good mortgage broker, right down to quantity surveyor, insurance broker. I know a lot of people in Melbourne. I'll give you my whole network of people that I use personally to build my wealth. No strings attached. So at least you have a good team around you. Financial planners and mortgage strategists are very important. There's very few good ones around. It took me decades to find these people, and there's not many good ones in Melbourne. So, you walk away with actual numbers and websites to businesses that can help you structure your whole property portfolio. There is a qualifying not strategy, I was going to say criteria. You've got to borrow at least 700,000. I don't have any properties in Melbourne, even in those cheapest areas like Scoresby, Reservoir, even two-bedders are going for 695, 700. Sunshine's the same. So you got to have at least enough to buy a two-bedroom townhouse. Otherwise, it can't help you. So if you're a single person, you've got to be in that kind of 95,000 per year and about 100 grand in equity or deposit. If you're a first home buyer, you can actually get away with very little deposit because we have a 5% first home buyers deposit scheme that's about to kick off in October with no LMI. So don't worry about the money, but income has to be there because you've got to borrow the money. If you're a couple, you need to be on that kind of 140 per year with about 100 grand in equity, then come and see me. All you got to do is send me an email, conrad@investorsprime.com.au, and we can book in a session as well. Thank you very much, guys. It's been a pleasure doing this video. This is Conrad Bobby Lex signing out, and I'll see you on the inside.